In the wake of the 2008 financial collapse, a profound distrust of traditional banks took root. A pseudonym named Satoshi Nakamoto proposed a radical alternative, a decentralized peer-to-peer electronic cash system built to exist entirely outside government control. Over the next decade, that cypherpunk rebellion morphed into a Wall Street obsession. Institutional investors flooded the market, transforming a theoretical digital currency into a highly volatile, mainstream speculative asset. This chart compares a traditional bond to Bitcoin's price history. Traditional investments, like shares or bonds, generate intrinsic cash flows, predictable returns through interest or dividends. Bitcoin pays no dividends. Its value relies entirely on supply, demand, and speculative trading, creating these massive, unpredictable price swings. That extreme volatility presents a glaring economic problem. A functional, day-to-day currency requires stability. If your money can lose 20% of its purchasing power overnight, you cannot rely on it to buy groceries, pay rent, or run a business. Yet, despite this fatal flaw, Bitcoin successfully powers a multi-billion-dollar global shadow economy. Criminal networks use it to move vast sums of wealth across borders every single day, completely bypassing traditional financial oversight. Millions of everyday traders riding the wild price fluctuations create a massive wave of public noise. That loud, chaotic market acts as a camouflage, masking a quiet, highly structured illicit economy operating right underneath it. To bypass the wild swings of the public market, criminal organizations have engineered their own economic rules. Inside the dark web, they trade Bitcoin at a fixed artificial peg, completely detached from whatever price Wall Street dictates that day. Organized crime has used this tactic for decades. The mafia, for instance, routinely assigns a flat €10,000 value to a Rolex Submariner. They use the watch to launder money and settle debts, ignoring its fluctuating real-world market price because it reliably encloses high value in a small, untraceable package. We see this exact behavior mirrored digitally. Transactions for illegal goods on dark web marketplaces consistently imply a steady conversion rate of roughly $20,000 to $21,000 per Bitcoin, even when the public price spikes to over $60,000. This creates a highly effective dual system. The criminal networks get a stable medium of exchange for illicit goods that never gets cashed out, while the massive volume of legal, public speculation acts as the float, providing the liquidity and noise necessary to hide their activities. The criminal underworld utilizes Bitcoin as a high-efficiency, fixed-value transport mechanism, a tool that moves wealth seamlessly beyond the reach of traditional regulators. Initially, criminals flocked to this technology because of the cloak of cryptography. The system uses a public key infrastructure, where a secret private key signs the transaction, and a visible public key masks the user's actual identity. But that perceived anonymity relies on a widespread misunderstanding of the technology. The underlying blockchain is a distributed, perfectly transparent ledger. Every single transaction is recorded permanently, and those records cannot be altered or deleted. Intelligence firms and law enforcement agencies recognize this vulnerability immediately. Today, specialized blockchain analysis companies treat this transparent digital ledger as an enormous, perpetually preserved crime scene. Investigators use techniques like cluster analysis to peel back the privacy layers. By tracking repeating transaction patterns, timing, and fee structures, they connect dozens of seemingly anonymous addresses, grouping them together to identify a single controlling entity. The ultimate trap is the fiat off-ramp. A fiat off-ramp is a regulated exchange or service where digital currency is converted back into traditional money. To cash out, criminals must pass through these bottlenecks, which legally require strict identity verification and documentation. The cryptographic architecture designed to build a trustless, untraceable financial system inadvertently created an inescapable, permanent audit trail, handing global law enforcement a map directly to the money. That forensic mapping of the illicit core brought an abrupt end to the early days of regulatory indifference. Governments worldwide have woken up to the threat, triggering a massive, fragmented legislative response. Responses vary wildly by jurisdiction. Some nations, recognizing the economic opportunity, have built progressive, legally welcoming environments. They integrate cryptocurrencies into their existing financial systems to attract fintech innovation and digital wealth. Other global powers take a sharply restrictive approach. Through outright bans, heavy taxation, and strict warnings, these nations push back against decentralized money to protect their own financial stability and maintain absolute monetary sovereignty. Observing Bitcoin's architecture has led governments to develop a specialized technological countermeasure: central bank digital currencies, or CBDCs. A CBDC is a digital form of a country's fiat currency, issued and entirely regulated by its central bank. This presents a stark ideological contrast. Bitcoin operates on a permissionless peer-to-peer network designed to resist control. A central bank digital currency adopts the efficiency of digital money, but relies on a centralized architecture, granting the state direct implementation of monetary policy and total oversight. Nakamoto invented Bitcoin to escape the grip of traditional state banking, yet its widespread use by the criminal underworld forced global governments to dissect the blockchain. In doing so, the state found the exact blueprint it needed to build a highly centralized, heavily monitored digital economy.